Welcome to today's Investment Foundation Certificate live learning webinar. This session is on Achieving Excellence, an overview of performance evaluation. This session will cover the evaluation process, relative returns and benchmarks, key ratios, and understanding alpha, and much more. And I'm delighted to introduce Tom Gordon. He's our instructor for today. Tom is a CFA charter holder, Director of Exam Development at CFA Institute. He's responsible for managing the processes and activities necessary to develop the CFA programme examinations and certifications.
Thank you very much, Catherine. That's a fantastic introduction. And first of all, welcome to everyone for coming to this session. It's an absolute pleasure to kind of go through just a slice of the Investment Foundation Certificate, or the IFC as I like to call it. In this particular session, what I'm going to do is go through just a snippet of what we call the overview of performance evaluation. Of course, my name's Tom. I'm obviously with the exam development team here at the CFA Institute. Well versed in kind of taking these sort of sessions, and to give you an introduction on performance evaluation, I think it's quite a nice way to kind of spend what is a lovely afternoon here in the UK. Beautiful weather at the moment, not too long, nice bite-sized kind of seminar. Someone asking there, who's this webinar for? Certainly for those individuals who don't necessarily have a background in finance, looking to kind of gain kind of a basic understanding of some of the kind of concepts that you might kind of come across on a day-to-day business within the world of finance. So what we're going to do today, just a kind of a snapshot, if you like, of some of the topic areas that we're going to look at. We're going to describe, first of all, the kind of concept of what we call performance evaluation. We kind of introduce the concept of a benchmark and how we can kind of utilize it in our ability to kind of engage in performance evaluation. We'll discuss the kind of concept of return, the fact that we can kind of compare it to what could be what we call a risk-free rate return, what we call a benchmark return, and that's all focused on the return aspect of our portfolio. But then, of course, we can't fundamentally talk about the return of a portfolio unless we also talk about the risks of the portfolio. So there are certain what we call reward to risk ratios, and there are some very popular, and certainly people might have heard of these along the grapevine, things such as what we call the Sharpe ratio or the Trainer ratio, and just kind of giving you a brief introduction to those ratios and how very much to kind of interpret what those kind of risk reward ratios would represent. And then what I'm also going to try and do, kind of finish off with this is actually something that kind of comes up in the CFA level 3 program, what we call performance attribution, where we could take a portfolio return and try and break the component returns into areas of, am I good at what we call stock selection? Is it down to things like my asset allocation? So what we'll do is we'll start. We said there the performance evaluation process just to begin with. So kind of breaking this down. So what I'm going to do through the performance evaluation process is understand how my investments are performing and evaluate them. Now, of course, how could I evaluate my portfolio? Well, key thing would be to identify what my return may be. So have I achieved a certain level of return? And we'll just look at quick ways that we can measure returns. There are many ways that we can measure return, but I'm going to show you a simple calculation called the total return of a portfolio. And then what I'm also going to do is identify that we can measure the risk of a portfolio, the fact that the returns can be good and bad, and that they are volatile. They may go up and down. So there are certain risk measures out there that we can also look at. Not that we're going to quantify it in today's session, but we can kind of narratively talk around the concept of standard deviation, for example, which is a key measure of risk that we can often look at on portfolios. And then what we'll do is say, well, I've generated a level of return and I want to compare my return. So we can compare it to what we call a benchmark. So some of you may have heard of terms like the FTSE 100 or the S&P 500. They are measures of kind of what we call, often referred to as benchmark returns. They're indexes upon which we might decide to compare our portfolio against, in which case We can then identify whether we have maybe beaten that benchmark return or if in fact we have underperformed the benchmark. So the idea that there are benchmarks out there, and we might look at, let's say, some of the features that we would identify when we choose a benchmark to compare our performance against. And then, of course, what would be some of the key reasons for us doing this? Well, if you are deciding to give me your money, you need to identify whether I'm any good or not. So in which case, we can obviously use this kind of performance evaluation process to determine the skill of the fund manager, and of course, implications of the fact that we don't take on too much risk when we try to generate that extra return through the evaluation or the performance evaluation process of, let's say, running a fund. So if we set this down into a number of steps, we just look here on the next page, we're going to break down pretty much this diagram with a few slides each. First thing we're going to look at is, say, we can measure what we call an absolute return. Put simply, an absolute return could be my portfolio has generated a return of 10% for the year. Absolute in the sense that what I haven't done is made a comparison as to whether or not I feel that that's a good return or a bad return. So the next step that we'll take is say, well, we can take that return and make it comparable, i.e. what we call relative. And what we could do is compare this. Now, bit of terminology you might see me use, right? So if I put this abbreviation down, RF, risk-free rate of return. Or it might be that my portfolio is invested into equity. And what I could do is go and invest into, let's say, the UK market, and that might be deemed to be, you see me write it, RB. This could be a benchmark return that I can compare against. We also said, we can't just talk about return unless we also kind of consider the risk aspects of the portfolio. So like I said, we've got what we call risk-adjusted returns, and we'll look at some sort of key risk-adjusted metrics, Sharpe ratio, trainer ratio, and also we'll also have a chance to look at the information ratio, and just very quickly try to interpret whether a higher or a lower ratio is deemed to be good from a portfolio perspective. And then it's kind of almost like you look back and say, well, can I attribute my performance to certain aspects of the investment process? And what we'll look at is say, well, can I break it down into stock selection? Could I break it down into asset allocation decisions? The first thing we're going to look at, as I said before, we may look at our portfolio and ask the question, what was my return over a particular time period? That return on its own, we often refer to that as an absolute return. There are several different types of return measure. Probably one of the easiest to understand and to understand and get your head around is the concept of total return. Okay, so very simple example. I decide to go and buy a share, 100 of your currency of choice. A period of 1 year elapses, and then at the end of the year, I find that the share is priced at 110. Let's say I decide to sell it. Now you can see that what's happened is that over that period of 1 year, there has been an increase by 10. Right. So what we could do is say that increase of 10 could be regarded as what we call the capital component of my return. Now, if I express that as a percentage return, taking the 10 that I've just generated in terms of a capital gain, expressing it as a percentage of the original price that I paid, which is 100, that's 10 divided by 100. You can see there that's going to be a return, right, which is equal to 10%. Right, and we often refer to that as the capital component return of your total return. If you like, that's a capital gain. Because you've invested into a company, the company's generated profits and pay them a dividend. So what we could also have in this example is the fact that over the period of 1 year, they received a dividend payment of 1, take the dividend you received of 1, express it as a proportion of the price that you paid for the share, which is 100, gives you a return of 1%. That's the income component of your return. and in which case you can then say that your total return will be the 10% capital gain that you've made plus the 1% income return in the form of the dividend, in which case your total return is 11%. But the question is saying, well, is that good? Is that bad? So what we're going to do is say, well, it's all well and good to look at what we call absolute returns. What we need to do is to make some sort of comparison. So the idea of relative is making a comparison. Okay. Now, the classic example is to compare the performance of my portfolio against a benchmark. And kind of classically, we'll find that there will be people like index providers. We've got the FTSE series, the S&P, so Standard & Poor's, and many different providers who will provide kind of, if you like, benchmarks that show snapshots of the market in different areas, so that what you could do is compare the performance of your portfolio against the benchmark. So it's kind of saying, well, if I was, and again, you may have seen this terminology before, fund manager may use the benchmark for assessment, right? Because my objective as a fund manager could be that I want to be better, right, than someone else. So this idea that a lot of fund managers may engage in what we call active fund management, and kind of put simply there is that your objective is to try to beat everyone else, and what you're trying to do is to beat the market. So the idea is that by using these relative returns, we often refer to the benchmark as being the opportunity cost, because using the skill of Tom, the alternative could be just to track the FTSE 100 and say, well, let's compare Tom's performance against the FTSE 100. Some investors believe that all they want to do is invest what we call passively. They want to track the performance of a particular market, in which case a benchmark could be specified and say, well, I want to construct a portfolio that mimics the FTSE 100. So you want your performance to track the performance of the FTSE 100. So how does a fund manager select the appropriate benchmark to compare the portfolio against? Well, a lot of that will kind of stem from the objectives of the fund manager. And this is where you'll find that the kind of world of indexes or indices is massive, because, people can break down into different styles. I'm a value investor, or I'm a growth investor. So by trying to determine where you believe you're going to add value, will then help you to determine what would be the appropriate benchmark for your portfolio. So the idea that, what would be some of the factors that I would need to consider when I do choose my kind of benchmark? Well, a few things, just a few kind of concepts, if you like. Investable, right? We want the benchmark that I choose to be comparable. Okay, it has to be transparent. Well, the FTSE 100, as an example, is transparent. It's the top 100 companies by market capitalization. Okay, that determines what weighting for each company makes up in the index, and that's transparent. And this is the kind of classic bias, and say, well, my return for the year was 11%. I'm going to choose a benchmark at the end of the year to compare my performance against. Do you know what? I'll choose the benchmark that has the lowest return because it makes me look better. So the idea that you should really choose your benchmark before the period of investment. So you kind of pre-specify at the beginning of the investment period your benchmark so that it avoids any kind of bias of selection, that you do it on a kind of a post basis. We've mentioned there that there can be different types of benchmark out there. Broad market, more narrow defined set of stocks, maybe 10 or so. Bond market, real estate market, hedge fund market. Like I said, big market out there trying to determine what would be an acceptable benchmark. What we try to do, what could be appropriate reward to risk ratios for an equity portfolio, right? So put simply, I've got the return of my portfolio, the RP, return of portfolio. My portfolio return, I'll make up a new number now, just because, again, I'm going to do this in my head, right? Return of the portfolio is 10%. Compare this against the alternative, which could have been just to put your money into a bank account, earned a form of interest, which is a risk-free rate of return. You can see here you've got this kind of excess return let's say the risk-free rate is 2%. Again, I'm making that number up. Then 10 minus 2, I've outperformed the risk-free rate by 8%. Happy days, right? Now, the top of that equation, which we call the numerator, what would you want that to be? Of course, right? I'll answer that. That's patronizing, right? You want the return of your portfolio to be as high as possible. The bottom part of that equation is a form of risk, what we call standard deviation of a portfolio. So put simply, if over a 4-year period, year one return was 12%, year two return was 8%, then it was 12% in the third year, right? 8% in the fourth year, right? No tricks. What is my average return over that 4-year period? Well, my average return, just simple average, right? Add them all up, divide by 4. You can kind of see it with the numbers that I've chosen being nice and easy. That's a 10% average return. But can you see that each year it was above average? 12% was greater than the average of 10. The second year, 8% was below the average by 2. So the kind of concept of standard deviation is it represents the average deviation away from what we call the mean return. The mean return is that 10%. Okay, and that was plus 2 in the first year, 12 versus 10. It was minus 2 in the second year, 8 versus 10. So the average deviation is 2%. So one key risk metric on portfolios is to measure the standard deviation of the returns. And of course, if that's risk, you're inclined, rationally to maximize returns. You're hoping to try to minimize the risk that you take on to achieve those returns. So if you can make the top part of that equation as high as possible, the bottom half to be as small as possible, then that causes that ratio, the amount of return above the risk-free rate, for each unit of risk you take on, with the Sharpe ratio, the higher, the better. So the idea that you can start to make comparisons between yourself and, let's say, it could be a peer fund manager to say, well, am I better than the person next to me? Well, I could do so through something called the Sharpe ratio. Now, other metrics, don't just rely on one. I mean, this is just a selection of many that are, you can kind of come across. These are some of the key ones that you might hear of along the kind of grapevine. This one here is what we call the trainer ratio. You've got no change on the top, but what you'll notice now is that there are several different risk measures. Standard deviation is just one of them, right? So another form of risk that you can use on a portfolio is to measure what we call the beta of the portfolio. Put simply, if this is a form of risk, then you want the risk to be as low as possible for the return that you generated. So again, just put simply, before I explain this kind of concept of the beta, the trainer ratio being as high as possible, again, it could be a good thing. Last bit I'm going to show you is the idea that if Tom was skillful, okay, he had an information ratio that was really quite high, right? So tracking error was really low, the information ratio was really high. Then what a lot of people often do at the end of the year is they'll say, well, why was Tom so good? What were the sources of return that we can attribute his performance against? Then that could be down to my stock selection abilities, asset allocation decisions. It could be stock selection decisions, currency exposure, sector selection, the kind of list goes on. People will engage in performance attribution. And again, this is where we're actually jumping from investment foundation certificate to CFA level 3, where they've got this in the syllabus. And there's also, we have the CIPM qualification here, or certificate of the CFA Institute, which is very much focused on things like return attribution, where we can take a portfolio and try and break it down into sources of return. Asset allocation, 0.9% of outperformance versus stock selection of 1%. But what I thought I would just show you here is, again, I've just kind of got, this is quite a standardized, what we call return attribution model, okay, called the BHB model, or the Brinson, Hood, and Bieboer model, okay. where we can try to break down our sources of return. So see if you can follow me on this, right? So at the top here, see the top table, this is my portfolio, okay? My portfolio is split between two asset classes, shares, i.e. equity, and bonds. And we have my portfolio, so portfolio weightings. So 60% of my money has been put into shares, 40% of my money has been put into bonds. By comparison, the benchmark allocation is just doing a 50-50 split. I have done something different to the benchmark. Now, the wording would be 60 in shares versus 50, right, which is benchmark. I have overweighted shares. I have underweighted bonds, right? So that's what we call an asset allocation decision. So what we could do is say, well, that asset allocation decision can be reflected as part of your outperformance, because my portfolio, see there, has returned a total of 7.4%, which is greater than my benchmark, which is 5.5%. So what we could do is we can measure the allocation effect by saying, take Tom's portfolio weight there in blue, compare it to the benchmark, which is in green. That's going to be a source of return if we assume that we have the benchmark return in shares and the benchmark return in bonds, because I would choose an equity benchmark and the bond benchmark, which I could just put my money into without any stock selection decisions. The differences in return for that portfolio would be down to asset allocation decisions, and that drives the asset allocation that you see there. Then what I find is that my portfolio for shares exceeded, okay, the benchmark, which is 10. The bonds, 2% return was greater than the benchmark of 1, because the composition of my portfolio return for equity and bonds was different to the benchmark because stock selection decisions. That has been built into the 0.5 and the 0.5 there of the selection effect, right? Which is also a source of my total difference in return of 7.4 versus 5.5, which is a difference of 1.9. And therefore, that's made up of what we call the allocation effect and the selection effect. You can just see there that stock selection is choosing stocks different to the benchmark. Allocation decisions are differences in my decision to go into equity versus bonds. And I thought, you know what? It's worth showing you those sort of numbers there rather than just say, okay, here's a graph. You've done well through stock selection versus asset allocation without showing you the sources of those returns. And that's what I wanted to kind of finish on.